gold rising sharply is a loss of confidence in fiat. Instead of gold failed, I would say gold was prevented from signaling stress properly, right? And in other words, the selling, the MOPE, as Jim Sinclair called it, management of perception economics, it wasn't allowed to signal things properly. It said it's just a crowded trade unwinding. And I would say, yeah, but who creates the unwind? Who's creating the unwind? Why is it that, they frame this as it's an overcrowded trade unwinding and ignore the massive selling on paper by the big banks? They talk about a highly leveraged futures market, thin margin requirements, large concentrated players, and that structure allows rapid price movements disconnected from physical flows. And I would say the crowded trade is the excuse, leverage is the tool.
The suppression of gold and silver prices in 2026 is a calculated management of perception economics designed to hide a systemic loss of confidence in fiat currency. By framing price drops as an overcrowded trade unwinding, the establishment uses leverage as a tool to disconnect paper values from surging physical demand. AndySchectman, president of Miles Franklin and a leading authority on monetary history, argues that this MOPE strategy, management of perception economics, is currently being deployed to mask the dire state of the U.S. economy. While the mainstream media focuses on paper liquidations, the data shows a massive physical drain. In March 2026 alone, over 1.25 million ounces of gold and 43.5 million ounces of silver were delivered on the COMEX, despite the price being clobbered. Furthermore, the appearance of 11,000 gold bull spreads targeting a $15,000 to $20,000 price range by December 2026 proves that the smart money is positioning for a vertical revaluation once the synthetic supply from ETFs and futures finally fails. As registered silver inventories have plummeted from 200 million to 79 million ounces in just 6 months, the gap between the rigged paper price and physical reality has reached a historic breaking point. Now, we present the clips from AndySchectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold was making all-time highs, so it's convenient for them to cite it now, but to ignore it back then, it's a bunch of phooey. That's a conventional wisdom. And, I would say to you that it's a lot worse than that, as far as I'm concerned. You look at the federal government, let's just call them Washington. They have no spending discipline, and the market should understand they can create credit out of thin air. And so far this year, we've taken in $2.1 trillion in revenue, but we've spent $3.1 trillion already. It's burning through $200 billion a month before the real war even showed up. And if you believe the official war estimates, maybe I have a bridge to sell you, because I was reading just the other day that the Iraq war was supposed to cost $50 billion and cost $5 trillion. It's not bad forecasting. It's deliberate deception followed by monetary debasement and fiscal irresponsibility. You got the IEA calling this the greatest oil disruption in history. Higher oil prices don't again mean higher inflation, which typically means higher interest rates. Neither one is good for a debt-heavy country that has to roll $10 trillion worth of treasuries. And it's funny, I have this, I actually wrote this down, not knowing that you would talk about it, but I might have to put my glasses on to see it. Let me see, because I read an article in the Wall Street Journal, and it bothered me. It talked about the mainstream was basically saying that gold failed as a safe haven, and it says, this is when gold is supposed to do well, and it says in a crisis, gold rising sharply is a loss of confidence in fiat. Instead of gold failed, I would say gold was prevented from signaling stress properly, right? And in other words, the selling, the MOPE, as Jim Sinclair called it, management of perception economics, it wasn't allowed to signal things properly. It said it's just a crowded trade unwinding. And I would say, yeah, but who creates the unwind? Who's creating the unwind? Why is it that, they frame this as it's an overcrowded trade unwinding and ignore the massive selling on paper by the big banks? They talk about a highly leveraged futures market, thin margin requirements, large concentrated players, and that structure allows rapid price movements disconnected from physical flows. And I would say the crowded trade is the excuse, leverage is the tool. I mean, I went through all of this to try to figure it out point by point. They said that dollar strength and real yields explain it, that the relationships are inconsistent. And, gold falls even when the dollar fell, and gold rose for a year without rising real yields. And I'd say those correlations are used when convenient. Again, we talked about that, ignored when they break. Margin calls, it's just liquidation. I would say, yes, there are margin calls and there are liquidations, but that's totally not the full story. You have the paper market allows mass selling without physical constraint, which we see, and the ETFs and futures create synthetic supply. All of this stuff is ignored, and so I guess it's managing the perception, and the Wall Street Journal wants to point to all of these negatives. But at the same time, let me just take a look at the numbers here real quick in terms of what has been delivered here so far. And we're seeing massive, by the way, in China, in the first 2 months of this year, by the way, they've had record, let's see if I can find the exact number. I'm sorry, I'm not completely prepared here. So far in the month of March, we've seen 12,532 gold contracts delivered and 8,713 silver contracts delivered. So that's 1,253,200 ounces of gold delivered as the price is getting clobbered, and 8,713 silver contracts times 5,000, that's 43,565,000 ounces of silver getting delivered, literally, as the price is getting clobbered. You have JP Morgan, according to the March 20th Commitment of Traders report, that right at the bottom, at the very bottom, they closed 633 short contracts, or 3,165,000 ounces short they cover. Are the banks getting on sides? Is that what they are using this for? Another interesting thing I wanted to talk about. We talk about the February delivery, right? February delivery showed that there was 38 million ounces that left COMEX, right? And that shows up, you can see that, right? I wonder if there's a correlation, because what we just found out is that the ETFs lost 38 million ounces of silver, SLV did, which got thrown back into the market. Almost exactly 38 million ounces left the ETFs, right? So is there any coincidence that 38 million ounces of silver left the ETFs, but 38 million ounces of silver left COMEX? So is it the same silver? Are they moving things around, like moving the deck chairs on the Titanic? And that's just, that was over the last 3 weeks, by the way. So it totally, the timing is exactly the same.
The narrative that gold failed as a safe haven is a deceptive piece of management of perception economics, designed to obscure a systemic loss of confidence in fiat currency. While the federal government burns through $200 billion a month and a $10 trillion treasury rollover looms, the paper market is being utilized to suppress prices through synthetic supply. By framing the recent price drop as an overcrowded trade unwinding, institutional players ignore the massive paper selling by big banks that disconnects market value from physical reality. The true story is found in the staggering delivery numbers. In March alone, over 1.25 million ounces of gold and 43.5 million ounces of silver were delivered as prices were clobbered, while JP Morgan simultaneously covered over 3 million ounces of shorts at the technical bottom. A suspicious correlation has emerged between the 38 million ounces of silver exiting the SLV ETF and the exact 38 million ounces leaving COMEX vaults over the same 3-week period. Despite mainstream claims that gold has lost its luster, the record-breaking delivery and loadout volumes prove that savvy investors are taking advantage of engineered price dips to secure the only assets that cannot be created out of thin air. As the debt-to-revenue gap widens and inflation signals stay suppressed by leverage, the eventual revaluation of the physical market remains inevitable. Let's get back to the interview.
The Bank of International Settlements came out and said, this is structural. This is not fundamental. It's structural in the respect that they said it is an increase in the massive amount of levered ETFs that had to reset in January. They had to rebalance because December, the price was up. They had to rebalance. And then margin increases, up. Everyone got squeezed like a grape. And they did. And so the leverage has disappeared to the point where Ed Steer, your buddy Ed Steer, great guy, is saying that it's the lowest short position that the commercial banks have ever had by a long margin in silver, ever. So could it be that they knocked the hell out of it to get on sides, to increase their long position? You know, the Economic Times said they're net long a while ago. That could be 11 long, 10 short. They're still short a lot, but net long. Well, are they getting more and more and more and more long? I would argue they are. And so, you know, I think you need to kind of look at these things with a little bit of, I don't know, you have to look at things, maybe not, you have to think outside the box. We can talk about things that are happening, again, that will massively change things. You know, India, as of, April 1st, has mandated that gold and silver ETFs switch from the London benchmark to domestic Indian exchanges as of April 1st, because it's a loss of confidence. They don't trust the Western benchmark price. Well, that's the same exact thing that we see happening, I think, around the globe. And I do believe here in the U.S. that the big banks have covered a huge position, a portion of their shorts. Open interest is incredibly low. There's been a lot of silver and gold that have been leaving the exchanges. These are, I think, when you have open interest as low as it is right now, that basically means that you don't have the managed money willing to take the other side of all of these trades, these short positions that the banks are putting on. And when you have low open interest, that means that you have the ability for the price to really slingshot when demand jumps into it. So look, all I can tell you is that all is not as it seems. Price is a tool of misdirection. And as the price has been hit, we're seeing so much in the way of deliveries here in the United States on COMEX, a lot of it leaving. 2 million ounces left the COMEX vaults on Friday. Just bye, see you later. You know, the numbers of offloads or loadouts, as they're called, where metal is leaving COMEX, is getting bigger and bigger and bigger. Once it leaves, where's it going? It's never coming back, ever coming back. And this is an important thing to think about. It's one thing to see lots of deliveries. We are seeing lots of deliveries. It's another thing to see lots of metal leave the COMEX ecosystem. It is never coming back. And this, to me, at the same time China is loading up, at the same time India is moving benchmarks away from the West. These are all things that I think are really, really important to understand. Metal leaving the ETFs, yet at the same time, the exact same amount leaving the COMEX. Is it filling a void so that it doesn't look as bad as it really is? I don't know. I mean, it certainly is interesting when you see the exact same amounts match up. When you see 1,253,200 ounces of gold be delivered here in March, and 43,565,000 ounces of silver, and the week or the month isn't over yet. These are all things that people need to understand. And this is why there is an entire theory of investing called wave theory. Kondratiev wave, Elliott wave, where it measures the cumulative emotions of the herd. 2 million ounces of silver leave on Friday, just load it out. There it goes, bye-bye. But that, according to Ed Steer, 102 million ounces of silver in January and February combined, plus 26,716,000 ounces of gold so far in March, were loaded out. And we're well into the 6th year of a structural deficit. So, what are we talking about? Actually, that's delivered. That's delivered. I don't know exactly how much has been loaded out, but a lot. We saw 28 million ounces loaded out in February alone. So when you see all of this metal being delivered and a lot of it being loaded out, meaning leaving the system, delivered could mean just going right into the eligible category. You know, you talk about speculation. Someone bought 11,000 December 2026 COMEX gold bull spreads between 15,000 and 20,000 after the crash, not before it. But what that basically means, there's a huge volume there. What that means is a bull spread, 15,000, 20,000 bull spread, a gold call, is that they buy 15,000. If it goes above 15,000, they win, and they sell 20,000. That spread between 15 and 20,000, they make a ton of money. This is the key point. Retail sold the panic. Large buyer used the washout to build a 1.1 million ounce tail risk position. Cost them roughly $3 million. And in other words, if it gets above 15 and gets up to 20, they win. If it gets above 15, they make a fortune, and then they sell 20. Who would do that? Who would spend $3 million thinking that by the end of December, we get to that point? And I would argue that what they are betting on is not gold. They're betting on exploding U.S. debt. They're betting on war spending, on increasing inflation, slowing growth, maybe even a recession. The energy choke point in the Straits of Hormuz, the fertilizer problems, the food pressure as a result of it, the sovereign strain that we're seeing all around the globe, and as a result, dedollarization. You know, in October, we just got a report that China has decreased its stockpile of U.S. treasuries to $688.7 billion, the lowest in 17 years. So the Fed's in a corner. They can't raise, they can't lower. If they lower, inflation is reignited. If they raise, the whole system breaks. And here we are, the Treasury up to 4.4% on the 10-year. Bonds are being sold. So that's the Fed's nightmare.
The structural shift in the global monetary landscape has reached a point of no return, characterized by a massive loss of trust in Western benchmarks. As India mandates a move to domestic exchanges and China reduces its U.S. Treasury holdings to a 17-year low of $688.7 billion, the physical drainage of gold and silver from the COMEX continues at an alarming pace. The smart money is already positioning for the endgame, evidenced by the 11,000 gold bull spreads targeting a $15,000 to $20,000 valuation by late 2026. This is not a bet on gold's utility, but a calculated play against exploding U.S. debt, de-dollarization, and a Federal Reserve trapped in a terminal corner. The current low open interest and record loadouts suggest that once this physical metal leaves the system, it is never coming back. We are witnessing the final stages of a structural reset where price suppression can no longer mask the reality of a global sovereign strain. If you found this breakdown of the $15,000 gold target and the collapse of fiat confidence essential for your financial survival, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.